Market maker definition, what it means and how they make money. Market makers are individuals or entities that act as a medium of connection between two parties interested in buying or selling shares. They buy the shares from one party at a price, match the requirements of the interested traders, and sell the shares to the most suitable individual or firm at another price. As a result, these players tend to make the market more efficient, more viable, and highly liquid. What is a market maker? The term market maker refers to a firm or individual who actively quotes two-sided markets in a particular security, providing bids and offers known as asks, along with market size of each. Market makers provide liquidity and depth to markets and profits from the difference in bid-ask spread. They may also take trades for their own accounts, which are known as principal trades. Key takeaway: a market maker is an individual participant or member firm of an exchange that buys and sells securities for its own account. Market makers provide the market with liquidity and depth while profiting from the difference in the bid-ask spread. Brokerage houses are most common types of market makers, providing purchase and sales solution for investors. Market makers are compensated for the risk of holding assets because a security's value may decline between its purchase and sale to another buyer. While brokers compete against one another, specialists post bids and asks and ensure they are reported accurately. Understanding market makers. Many market makers are often brokerage houses that provide trading services for investors in an effort to keep financial markets liquid. A market maker can also be an individual trader who is commonly known as a local. Due to the size of securities needed to facilitate the volume of purchases and sales, the vast majority of market makers work on behalf of large institutions. Each market maker displays buys and sell quotations for a guaranteed number of shares. Once the market maker receives an order from a buyer, they immediately sell off the position of shares from their own inventory. This allows them to complete the order. In short, market maker facilitates a smoother flow of financial markets by making it easier for investors and traders to buy and sell. Without market making, there may be insufficient transactions and fewer investment activities. A market maker must commit to continuously quoting prices at which it will buy or bid for and sell or ask for securities. Market makers must also quote the volume in which they are willing to trade, along with the frequency of time they will quote at the best bid and best offer prices. Market makers must stick to the parameters at all times during all market outlooks. When the markets become erratic or volatile, market makers must remain disciplined in order to continue to facilitate smooth transactions. Making a market signals a willingness to buy and sell the securities of certain set of companies to broker-dealer firms that are members of the exchange. How market makers earn profits. Market makers are compensated for the risk of holding assets because they may see a decline in the vast security after it has been purchased from seller and before it's sold to a buyer. Consequently, the common charge aforementioned spread on each security they cover. For example, when an investor searches for a stock using an online brokerage firm, it might observe a bid price of 100 and an ask price of 100.05. This means the brokers purchase the stock for 100 and then sells it to prospective brokers for 100.05. Through high volume trading, a small spread can add up to large daily profits. Market makers must operate under a given exchange bylaws which are approved by the country's securities regulator, such as Securities and Exchange Commission (SEC). Market makers' rights and responsibilities vary by exchange and by the type of financial instrument they trade, such as equities or options. Market makers versus specialists. Many exchanges use a system of market makers, each competing against one another to set the best bid or offer in order to win the business of orders coming in. But some, like the New York Stock Exchange (NYSE), have a specialist system instead. The specialists are essentially lone and designated market makers with a monopoly over the order flow in a particular security or securities. Because the NYSE is an auction market, bids and asks are competitively forwarded by investors. The specialists post these bids and asks for the entire market to see and ensure that they are reported in an accurately and timely manner. They also make sure that the best price is always maintained, that all marketable trades are executed, and order is maintained on the floor. The specialist must also set an opening price for the stock each morning, which can differ from the previous day's closing price based on after-hours news and events. The specialist determines the correct market price based on supply and demand. Example of market maker. Here's a hypothetical example to show how market makers trade. Let's say there's a market maker in XYZ stock. They may provide a quote of $10 to $10.5, 100 shares times 500. This means that they made a bid they will buy for 100 shares for $10 and also offer they will sell 500 shares at 10.05. Other market participants may lift the offer from M $10.05 or sell them to hit the bid at $10. Who are market makers and what do they do? A market maker participates in the securities market by providing trading services for investors and boosting liquidity in the market. They specifically provide bids and offers for a particular security in addition to its current market size. Market makers typically work for large brokerage houses that profit off the difference between the bid and ask spread. How do market makers work? A number of market makers operate and compete with each other within security exchange to attract the business of investors through setting the most competitive bid and ask offers. In some cases, exchanges like the NYSE use a specialist system with a specialist as the sole market maker who makes all the bids and asks that are visible to the market. A specialist process is conducted to ensure that all marketable trades are executed at a fair price in a timely manner. How do market makers earn a profit? Market makers earn a profit through the spread between the securities bid and offer price. Because market makers bear the risk of covering a given security which may drop in price, they are compensated for the risk of holding the assets. For example, consider an investor who sees that Apple stock has a bid price of 50 and an ask price of 50.10. What this means is the market maker bought the Apple shares for $50 and is selling them for 50.10, earning a profit of 10 cents. Some frequently asked questions. Who are market makers? Market makers are individual firms that act as buyers for those interested in selling and sellers for interested in share buyers. As these market participants maintain a good balance in the financial market, they tend to be the best source for keeping markets active and liquid. How do market makers make money? The bid-ask spread is earning for the market makers, individual or entities. This is a spread defined as the difference between the bid-buy price, sell price. Through this different amount is too low per share when calculated as a set of shares of stocks. These become a significant figure as a daily income for these markets makers. Do market makers manipulate price? The market makers buy shares at a lower price and sell them at a higher price. The higher this difference or spread is, more is the earning. Thus, they are believed to be manipulating the price, sometimes as per their interests. Some key takeaways. Market makers are individuals or firms that act equally on both sides of the buy and sell side of a financial market to facilitate the smoother trade. By helping investors sell shares at a bid price and buy from them at an ask price, these market makers entities maintain significant trade volumes and active market. The difference between the bid and the ask price or bid-ask spread becomes their profit. They are different from brokers functioning in the market who get paid in commission for each achieved transaction. Understanding how market makers make their money will help you become a better trader and investor. You know the catchphrase. Study it, analyze it, adapt it. Peace.